Hello and welcome to this week's Australian Share Market Report. I'm Dale Gillam, Chief Analyst at Wealth Within. This week I'll be discussing the difference between a bull and a bear market and how you can recognise them, and also share with you my thoughts on the All Ordinaries Index. Now before we jump into the report, I'd just like to mention if you have any thoughts on investing or trading, please comment below. And remember to subscribe to the channel to keep up to date with our new content. So let's get into the report. Now the terms bull and bear markets are often used to describe how stock markets are doing in general, whether they're rising in value or going down, and worse, what actually constitutes a bull or bear market. So what is a bull market? Well, it's generally accepted that a bull market is a market where prices are rising and expected to rise further. So what is a bear market? Well, it's generally accepted that a bear market is a market where prices are falling and are expected to fall further. Now, whilst those explanations are technically correct, they are quite broad and do not really tell you how to determine or recognise either the bull or bear market. To do this, we need to put some parameters around the definition, which I'll do in a minute. Bull and bear seem like odd names to use to describe a stock market movement for the most part, but interestingly, the terms came from the way animals attack their prey. A bull thrusts its horns up into the air, while a bear swipes its paw downwards. These actions are metaphors for the movement of a market. If the trend is up, it's a bull market. If the trend is down, it's a bear market. Bull markets typically tend to span for longer periods of time and generally have greater returns than bear markets. This is a sign of a growing economy. As you're reading my book, Accelerate Your Wealth, I discuss that generally 1/3 of the time a market is falling and 2/3 it's rising or going sideways. Now, due to the fact that bear markets are so short and sometimes quite severe, it's often difficult to get out of them in time if you're not experienced and knowledgeable. In many cases, by the time people realise they're in a bear market, the run is so severe that they start to panic sell or they become frozen in their decision making and so hold on to continue to suffer more losses. Interestingly, at this stage, they do not realise that they are now much closer to the beginning of the next bull market. But given that they often panic sell, they are more likely to miss on maximising the next bull run. Remember, amateurs buy at the top and sell at the bottom. And so this alone suggests that the majority don't understand bull and bear markets. So what can you do? Well, in a bull market, investors should take advantage of rising prices through buying early and then selling later when the prices have reached their peak. During a bull market, investors can invest in more equity with higher probability of making a return. They may even want to use leverage to increase returns, as this can be a good strategy in a bull market. In a bear market, the chances of losses are greater because prices are continually losing value. Investors are far better off selling or moving capital to safer investments such as fixed income securities or cash. Leveraging during these times is highly risky. A bear market should not be confused with a correction, which is a short-term trend that has a duration of fewer than 2 to 3 months. While corrections offer a good time for value investors to find an entry into stock markets, bear markets rarely provide suitable points of entry. This is because unless you're knowledgeable about trading, and more importantly, understanding the concepts of price, pattern, and time, it is almost impossible to determine a bear market's bottom. Therefore, trying to recoup losses can be an uphill battle for you. Now, a bear market is when the market falls by over 25% for a sustained period of longer than 3 months. A bull market is essentially the opposite, where the market is consistently rising for more than 3 months and 25% in price. Now, whilst these definitions are more defined, they are still general in nature rather than hard and fast rules. So let's get into the charts. Alrighty, let's get into the charts. Today I'm going to be covering the All Ordinaries Index. I'm going to go through the Aussie US dollar because that's looking quite interesting. And then I'm going to bring up a couple of the sectors where I think you need to be looking at for some great stocks. So on your screen right now, you can see the All Ordinaries Index. It's the weekly chart that I normally have up there for you. As you know, the last few weeks I've been talking about our market being more bullish or becoming more bullish and breaking through that previous high here from or at 6,245 points. I thought it would break through that and move up into that sort of 4 to 6566 sort of range in our market. So I'm thinking it's going to really sort of attack that previous all-time high back from 2007. Right now, what we can see here is it did fall down into that range there, that 6,087 point range. Last week it was looking more bullish, but the 2 weeks ago it was looking more bullish. Last week was quite interesting. If you look here, last week was finished, it closed on the 15th of June, Friday the 15th of June. It closed at 6205. But if I take it down to the daily chart, you can see it was a bit weak going through all of that week. It was quite weak, but on the Friday it had an 81.6 point range, as you can see there, to close quite high at 6205.3 points, and in doing so it broke above that high of the 7th of June the week earlier. At that high was 6181. Doing that's now confirmed to me that this market is bullish, or the Australian market is bullish, and we will break through that 6245 area there and continue on. So it's a really nice time to start looking at getting a few extra stocks for your portfolio. Now let's have a quick look at the Aussie US dollar, because that's an interesting thing to me. At this point in time, you can see here, I'll just expand that up a little bit for you. I can show you. It was doing it was drifting up, and it drifted up there into that week ending the 8th of June, hitting a high of 76 before closing at slightly lower, 75.98 cents or US cents into that. Last week, you can see a big bar there on this weekly bar here, the ending there. It closed at 74 cents US, or 74.44 US cents there, in a nice big long bar. And what interesting thing to me is, I'll just bring it up here, is I think we're now going to drop a little bit further. It's going to continue this sort of nature at this point in time, but in a short time frame it's doing what it did over this big long time, over 2 years. So here it's broken through this 50% level at 74.8 US cents here. I think it's going to come down to sort of that 73.2 US cents. So I think over the next few weeks we're going to see a little bit more falling away. Again, it was another big last couple of days on the market here. So if I drag that up, you can see here it's broken out of this sort of pattern here, this sort of rising pattern that we're seeing there. That's generally a bearish signal. So as I said, there's no surprise to me it's dropped down below that, and it is heading for the next thing. So if you're looking at booking overseas holidays, I just hang off for a little bit at the moment, because you're going to end up paying a little bit more. If you're looking at probably 6 months down the track, I think it's going to be a little bit different at this point in time. Let's get into a couple of the different sectors. This is the metal and mining index. I think it's a really good looking index at this point in time, and you can see here how it's been really, really bullish there on the monthly chart on that left of the screen. It's still heading up. It's at 4,000 points. Good stocks are to be held in that sector, and we'll look at that a little bit more anyway, but in terms of the metals and mining. But look for the big stocks in here, not the smaller ones. We're talking about the top 50 stocks in there, not going into some of those smaller ones at this point in time. I've seen a few people trying to get into lithium, and I've had questions on that, and they're going, hey, let's get into lithium, everybody needs it for their batteries. But I did a recording a little while back on lithium. There's a few lithium stocks I looked at, and I don't like any of them, and it's an interesting thing that people are looking for these things and trying to speculate, making some good money. But BHP and Rio have made far more money than those lithium stocks. Looking at here, consumer discretionary is another one of these kick-ass sectors in our market at the moment. Consumer discretionary is another one. So we've got metals and mining, we've got consumer discretionary, some really good stocks in that sector here. Again, it's been quite bullish, looking really, really, really nice. Still way off its all-time high way back here in 2007, but is looking good. The other sector that I do like is energy, and you can see here how since its high way back in June 2008, it just kept falling and falling and falling, and so it's been really hard hit down to January 2016, but since then, like the metals and mining index, it's looking really good, and so some great looking stocks in that sector for you at this point in time. So get stuck into having a look at those. I'm just going into the materials sector. This is where your BHPs, your Rio is, your Fortescue is, all stocks to look at this point in time. And again, as you can see here, like the metals and mining index, is pretty similar. June 2008 was its high, then that 2016 low. That's why I still think there's a lot more opportunities there. I just want to show you, just before I finish up, Myer. This is a stock that I'm looking at the moment. It's been hard hit, and I know people are saying to me, why would you buy Myer? Like, look at it, why is that exciting? Because it's been so bearish. It's gone from that high of $1.46 in August 2016. It's now 40 cents. Now, it's not too cheap for people to buy, so please don't think buying it because it's cheap. I want to wait for it to start to go up at this point in time, and it's showing me some signs that it's possible that it will do this, but just keep this on your watch list. I'm not suggesting to go out and buy it straight away, but have a good look at it. That's it for me on the charts this week. Good luck, good trading. What are your thoughts? If you've got any questions, please comment below. Go and listen to our Talking Wealth podcast. They're available on Soundcloud and on our website. Now, they're jam-packed with valuable information which will help you elevate your trading. Now, if you're serious about learning to trade the share market and you'd like more information about our courses, please click the link in the video description below. Thank you very much for watching this video. If you've liked the video, remember to subscribe to keep up to date. I'm Dale Gillham, the Chief Analyst here at Wealth Within. Goodbye, good luck, and good trading.